because this green line is our maximum profit potential in this position. Now, if you look down here in the left-hand corner of this picture, you notice as I move the cursor around, it gives you different numbers. Right now, on total, our position is generating about $20. Actually, this is a little bit different than the monitor trade I show you up here. We're actually up about $51. But because they take into consideration the bid and ask spreads, this might be a little bit lower than what you just saw. But it's still $1,600 in margin. If you run the cursor over this green line, this is what happens when options expire. Remember, there's only two rules of the market. One is prices will fluctuate. Number two is all options expire. Well, when we put these positions on, the only thing that we're interested in is having these options expire within this profit range. We have a fairly large range that our prices can move in, and that's what I mean by the fact that prices will fluctuate. Well, prices can fluctuate up, and they can fluctuate down. It does not matter for our position. All we have to do is be patient, wait, and collect our money at the end of the month when these options expire, or just prior to when the options expire. Let's take a look at the cursor. Now, if you can see down in the left-hand corner, you can see that even at this point, if prices were to move down significantly, we would still have a profit of $1,234 on this position at expiration if prices move down. Now, we have a margin of $1,600. What kind of a return on investment is that? That's close to an 80% return on, maybe even more. If prices moved up, we might even make even more money. We have a maximum profit potential of $1,300 on this position. If you look down here in the left-hand corner, we're looking at the date of expiration, which is May 17th, not the current date, which is 4/29. We're looking at May 17th, which is the option expiration date. We have a profit potential here of $1,327.27 at expiration. That is close to a 95% return. Now, you might be thinking, well, gee, Dave, that's great. $1,600 and you're making, $1,600 in margin, you're making $1,300 or whatever. Even if this landed someplace in the middle, you're talking not less than $1,000, anywhere from like $1,100 up to $1,300 right in the middle. So even if it went up or even if it went down, if it went way down here, well, now your profit margins are a little bit lower, but I can show you exactly what to do when you need to adjust those, so that your profit potential is actually a fairly wide range here in prices, so that the market, so you're really taking advantage of the market's fluctuations. It doesn't matter if the market goes up, it doesn't matter if the market goes down, because you make money either way, and all you have to do is put these positions on 3 to 4 weeks before they expire and just sit back and just let them run and cash in a few days before expiration. Let me show you. Let me tell you exactly what the actual potential of this is. $1,600 margin, not much. Maximum profit, maybe around $1,300. If you were to put, let's say, double that, okay, now you're putting up $3,200 in margin. Now your maximum profit potential is anywhere from $2,400 to $2,600 for only $3,200 in margin. Let's say you did 10 times that. I put $16,000 worth of margin up. What's my profit potential now? My profit potential is $12,030 in this position at that one end, and $13,375 at this end. And if it's stuck right in the middle, it's $10,335 in 3 weeks to 4 weeks. And those are not, even that's not a very large position. That's only 10 times the margin. So if you had $16,000 in margin,